Hello dear students, now let us see chapter number 19 of S Corporation Income and Basis. In the last session we had discussed about a basic eligibility criteria for the S Corporation, who can be elected as a S Corporation status, everything we had seen in the last discussion. Now we are going to see the income and basis, how a income will be distributed to the shareholders and how a shareholders basis will be calculated. This is going to be discussed in this unit. Okay. S Corporation to report the income to the shareholders at the end of the year. So when S Corporation ends its tax year, at that time they will report the income to the shareholders. Tax year, generally S Corporation follow a calendar year. Look at this, S Corporation has to follow calendar year in general. However, fiscal year may be followed with the permission of IRS. Fiscal year means any other year other than the calendar year, any of the year can be followed by S Corporation if IRS gives a permission, and IRS will give a permission only when business purpose, that is more than 25% receipt in the last 2 months of the year is there, then only IRS will give a permission. Else in general, all S Corporation have to follow calendar year as a tax year. Income reporting. Calculation of income is the same as a partnership. As we have discussed in the partnership, the same rules are going to be applied for S Corporation. So in the similar manner, the income will be calculated. S Corporation may follow cash basis, as we seen in the partnership also, they can follow cash basis. So S Corporation can also follow cash basis for accounting, for tax purpose. S Corporation reports ordinary income and separately stated income to the shareholders. As we have seen in the partnership, the same rule is there. Ordinary income and separately stated items, both will be reported separately to S Corporation, to shareholders. Due date of IDR filing is the 15th of the third month. 15th of the third month, that is, let us say year is ended on January, then third month will be March. Up to 15th March the return should be filed. Penalty for late filing of ITR is $200 per month per shareholder. If you are filing a ITR late, then you will be charged with a fine that will be $200 per month per shareholder. Okay. Now flow through of income to the shareholders means how the income will pass on to the shareholders from the S Corporation. Income is distributed to all the shareholders on an ownership basis. Look at this, ownership basis. So when you are a shareholder of a S Corporation, you will be allocated a income from the S Corporation on the base of your ownership. Whatever may be your ownership percentage. Let's say you are a 10% owner, then the 10% of income and expenses will be passed on to you. In case of change in ownership, that is a sale of stock, when you are selling a stock or when you are purchasing a further stock, there will be a change in the ownership. What to do at the time? Income is allocated up to the date of sale on a proportionate basis. Income has to be made proportionate up to the date of sale, and that income will be allocated to a shareholder. How to proportionate? Total income of the year divided by 365 days into number of days up to the date of sale of stock into ownership percentage. That is going to be allocation of the income. For example, an S Corporation is there whose annual income has been 1 lakh for the year 2019. Now let us say a shareholder Mr. X was there who was holding on 1/1/2019 20% of the stock, and let us say on 21st June 2019 he sold 5% of the shares. Okay, first of all, let's see an example where he is selling all the shares. Then we'll go with a partial sell. But let's say on 21st June 2019, he sold all the shares. Let's take first this example. Now what will happen? Total income for the year is 1 lakh and he has sold the shares on 21st June. So we need to first of all calculate the days. See, January 21, February 28, March 31, April 30, May 31 and June 21 days. So it is total coming to 172 days. It means we have to calculate income for 172 days. How it will be? Total income 1 lakh into 172 days divided by 365 days. So 1 lakh into 172 divided by 365. So it is coming to 47123. Okay, into your percentage was 20%, so you need to multiply 20%, 47123 into 20%. So it will be 9425. Okay, it means 9425 worth of income will be allocated to this shareholder. Fine. So you need to consider he has sold his shares in between the years. So you need to make an income proportionate and only up to the date of sale, whatever income is relating to up to the date of sale, it will be allocated to the particular shareholder on ownership basis. So that should be the calculation. In case of complete sale of stock or debt of the shareholder, the calculation is done up to the period by closing the books if all the shareholders, including the outgoing shareholder, agree for the same. Otherwise, allocated when the tax year actually ends. See what they want to say, when to close the books of account and when to make this calculation. There are two options. One option, as I told you, he is selling the shares on 21st June 2019. So the calculation may be made on the year end, that is 31st December 2019. That is one of the option. What the corporation will do, they will close the books on 31st December 2019 as usual, and then they make a proportionate income of to just allocate to the shareholder. Or other option, they can close the accounts on 31st June 2019 itself, and then they can allocate to the shareholder. So there are two options available. Whatever option may be selected by the taxpayer. Default option is what? It will be done on 31st December 2019 only, which is your natural year end. If you want to close the account on 21st June itself, then a consent of all the shareholder is needed to do the same. Okay, so this is how the calculation is made. Now, QBI deduction is available to the shareholder on a distributive share of the shareholder. Distributive share, whatever income is being distributed to a shareholder from S corporation, that is subject to QBI deduction, qualified business income deduction. QBI deduction is going to be levied on that part. Fine. So that you need to consider. We have seen that you are getting a benefit of QBI deduction. So 20% of income will be deducted from his distributive share. Now friends, basis of stock. How to calculate a basis of stock? The basis of stock of each shareholder is adjusted each year by a contribution, distribution, income, losses and expenses. As we seen in the partnership, the same rules is being applicable here, except the changes in the dates. That part is not here. Otherwise, all the things are same. Just say for example, initial basis plus contribution of the property by shareholder. Whatever property shareholder is contributing to the corporation, it will be added to his basis. Plus distributive share of the income, including exempt income. And exempt income will also be included in the part of initial basis. So it will be added to that. Share of ownership of the shareholder. That part of income will be added to his basis. Plus distribution from AA and OA, that will discuss in the later section of the chapter. Next chapter actually. That is AA and OA is nothing but accumulated reserves of the organization S corporation when it is shifting from C corporation to S corporation. That is called AA and OA. That will discuss in the next chapter. Less distribution of cash property to the shareholders. If the corporation is distributing cash or property to the shareholder, it will be reduced also. And less non-deductible expenses and losses. So all these things to be added and deducted, and finally you will get a closing balance. If you just think it's logically, it's nothing but a normal calculation. Initial basis plus contribution of property plus income share, less distribution, less loss share, and less, we can say, deductible expenses. So this is going to be your final calculation of basis. It's similar to partnership. No more changes. Loss limitation. Loss is deductible to the shareholder. First, up to the basis interest in the corporation, we will see the same rule as we have seen in the partnership. Once the basis becomes nil, the loss can be deducted up to loan basis of the shareholder. In this case, a future increase in the basis, first revise the loan basis and then increase the capital basis. Now what they want to say, let's see. Shareholder X and A corporation. Now let's say shareholder X has an initial basis of 5,000. A corporation incurred a loss of 20,000. And let us say X has a 60% share in A corporation. X has 60% share in A corporation. Then this 20,000 loss, 60% will be allocated to him. So it will be 12,000. But basis of X is only 5,000. So he can deduct the loss up to 5,000 only. So basis will become 0. Now let us say X has also given a loan to S corporation worth 4,000. Loan worth 4,000 is also given. So he can deduct the loss up to loan basis also. In that case, loan basis will also become 0. Fine. He can deduct the loss up to basis, that's okay. He can also deduct the loss up to loan basis, then loan basis will become 0. Now you see 5 plus 4, 9,000 of loss has been deducted. So remaining 3,000 loss will be carried forward. Okay, now whenever in the future there is a gain, allocated to X, first the loan basis will be revised, and then initial basis means interest will be revised later on. So the same treatment to be given. As in the case of loss, we are reducing first initial basis and then loan basis, and in the case of gain, first loan basis to be increased and then to go for the capital interest basis. Loss is deductible up to at risk value of the shareholder, as we have seen in the partnership also. Passive loss is deductible up to passive income only. Unused losses are carried forward infinitely for the future deduction. As we seen right now, whatever loss you cannot deduct in the current year, it will be carried forward infinitely for the deduction set off in the future years. Excess business loss is deductible up to 2,50,000 or 5 lakh single or joint filing in the current year, and balance is added to annual carry forward. Same rule as we have seen in the individual taxes and partnership taxes and all, we have the same rules because it is ultimately passed on to the individual only. So it is applicable for individual. Losses can be deducted in the current year up to 2,50,000 or 5 lakh depending on the return filing status, joint or individual. Okay friends, so this being the theory for chapter number 19. Now friends, let us see the MCQs of chapter number 19, S Corporation, Income and Basis. Question number 1, A paid 25,000 to S Corporation for 25% ownership. During the year, S Corporation reported operating income of 60,000, exempt income 10,000. S Corporation also distributed a dividend of 20,000 to its shareholders. What will be the tax basis of the shareholder A at the end of the year? Now they are asking a tax basis. Okay, so first of all, we start with the initial basis. Initial basis is 25,000 as he has purchased the shares for 25,000 plus income, share in the income. See, there are two types of income and both is going to be added. So 60,000 and 10,000, 70,000, and 25% is his share into it. So 70,000 into 25%. So it is going to be 17,500 that will be added. Less distribution. Okay, dividend distribution was 20,000 and out of which his share is 25%, so 5,000. That will be reduced. Okay, finally 25,000 plus 17,500 less 5,000 is equal to 37,500. So that is the correct answer, C option, 37,500. That will be closing basis. Okay, next question number 2. Mr. X tax basis of a stock at the beginning of the year was 30,000 in S Corporation, 40% ownership. Also, he had given a loan to a corporation 20,000, out of which 5,000 was repaid by the corporation. So it means now loan outstanding is a 15,000. Corporation reported operating loss of 2 lakh. How much of loss is to be reported by Mr. X? Okay, now you see loss reported by S Corporation is 2 lakh, and out of which share of Mr. X is 40%. 2 lakh into 40% will be 80,000. 80,000 of the loss is allocated to Mr. X, but this loss can be set off only up to capital basis. Now what is his capital basis? Okay, his capital basis is 30,000, so he can deduct up to 30,000 as a capital base, and remaining he can deduct up to loan basis also. Now loan basis is how much? Out of 20,000, 5,000 of loan has been repaid, so 15,000 is a loan basis. So he can deduct 30 plus 15 is equal to 45,000 of loss can be deducted as a capital base and loan base, and remaining will be carried forward. So remaining will be 35,000. 35,000 of loss will be carried forward. So 45,000 can be reported in current year as a deduction. So answer is C option. Next, question 3. Smith, a 100% shareholder in a S Corporation, has an initial base of 50,000. During the year, S Corporation reported operating loss of 20,000. Exempt income 5,000, STCG 8,000 and LTCL 15,000. What will be the tax basis at the end of the year? Simply, you need to just calculate the tax basis. So just let's add and deduct everything. Initial is a 50,000. Operating loss will be reduced to 20,000 minus. Exempt income will be added to plus 5,000. STCG will be added, gain added. LTCL loss will be reduced, 15,000 minus. So answer is 28,000. A is the correct option. Fine. Next, A and B were equal owners of X Corporation, who is having a S status. Basis of the stock of both were 10,000 and 15,000 respectively. During the year, X reported a business income of 50,000 and exempt income of 20,000. X distributed 25,000 to each of them. Look at this, each of them. What will be the basis of stock of A at the end of the year? They are asking about A only. Okay, so initial basis of A. Initial basis of A is a 10,000 plus share in the income. Now there are two type of income, business income and exempt income. 50 plus 20, that is 70,000, and equal partners. So half of the income will be distributed, 70,000 and half, so it will be 35,000. Half of 70,000. Less distribution. How much distribution is given? 25,000 to each of them. So you will get 25,000 distribution. Let us reduce. Okay, now just check. 10,000 plus 35,000 less 20,000. Answer is 20,000. That is a correct answer. Option number D. That is your correct answer. An S corporation follows a year ending on 30 September. Its receipt is 40 million. Shareholder now wish to change the status to C corporation following a cash basis. Which of the following is true? See, now they want to change to a C status. So now once you move to the C corporation status, you cannot follow cash basis. You have to compulsorily go with the accrual basis. And as a C corporation can follow any of the years, so the old year will be continued. So we can say answer is 30 September using a accrual basis. B option is a correct answer. Next, Karen is a 60% shareholder in a Creator S corporation. During the year, Creator reported business income of 1 lakh and distributed 50,000 to its shareholder. How much of income is reported by Karen in his return? Look at the question. How much of income is to be reported by Karen in his return? They are asking only income to be reported. They are not asking the basis. So if I talk about income to be reported, business income was 1 lakh. So 1 lakh into his share is 60%. So very simple. 1 lakh into 60%, 60,000. A is a correct answer. Next, as on Hobbs owned 40% of the stock of Avengers Corporation at the basis of 20,000 as on 1/1/2019. He sold the entire stock after 50 days for 28,000. Loss reported by Avengers during the year was 73,000. How much of loss is to be reported by Hobbs in this year, in his return? Okay, fine. 73,000 is a total loss, annual loss, and he has sold all the shares in 50 days time period. Okay, then what we do? 73,000 into 50 days divided by 365 days. So this is going to be proportionate loss for 50 days. That is going to be 10,000 into the shareholders ownership percentage is a 40%, so it will be 4,000. 4,000 of loss is to be recorded by shareholder Hobbs. The answer is C. Now the next one, question number 8. Marvel Corporation's S status was terminated on 1st May 2019 in the current year. During the year, income reported was 65,700. If no election is made by the shareholder, how much of the income is to be reported by Marvel in 2019 as a S status? Okay, now S status has been terminated in the current year, so it will be divided in two parts. Previously S status and then C status. Now they are asking how much income will be reported as a S status. So we need to just make a proportionate. Okay, total income is 65,700 and 1st May. So you need to calculate the days actually. January 31 days, February 28, February 28, March 31, April 30. Okay, fine. 1st May the status has been lost. So if we just make a total, then 31 plus 28 plus 31 plus 30, it is 120 days. Okay, so 65,700 is a full year income. 65,700 into 120 divided by 365. 65,700 into 120 divided by 365, 21,600. So that is answer. So it means 21,600, option B will be the correct answer. That is the income to be reported by S status, and remaining will be C status. Chris owned all 1,000 shares of S Corporation on 1/1/2019. He sold 400 shares on 1st May 2019. During the year, the corporation reported income of 1,09,500. How much of income is reported by Chris in his return? Okay, look at this. On 1/1/19, he was holding 1,000 shares. It is equal to 100%, all the shares. And then on 1st May 2019, he sold 400 shares. So now his holding will be 600 shares. That is equal to 60%. So income has to be divided. Okay. 1st January to 1st May. That is 120 days. Now total income has been 1,09,500. Out of that 120 days income. So 1,09,500 into 120 divided by 365, 36,000. This 36,000 and his ownership percentage is 100%. So total 36,000 is going to be reported to him as income. Now then from 1st May to 31st December, remaining income will be 109,500 minus 36,000. 109,500 minus 36,000. It will be 73,500. Okay. And into his share now will be 60%. So it is 44,100. So friends, first of all he has to report 36,000 and then 44,100. Let's make a total of it. It will be 80,100. So in total 80,100 of income is to be reported by him. Answer A is the correct option. So 80,100 of income will be reported by Chris in his return. Next, S corporation has to follow which of the following year in general? Okay, which year is generally followed by S corporation? That is a calendar year. So A is the correct option. That's a very simple answer. So friends, this being MCQs for chapter number 19. Now friends, let us see the discussion on next chapter, chapter number 20, distribution and special taxes of S corporation. This is the last topic for S corporation, we can say. Here we are talking about the distribution of income to the shareholders and the tax perspective. Okay, distribution, what are the rules for distribution? Corporation has to recognize a gain on a distribution of appreciated property to the shareholders. The same gain will pass on to the shareholder as a part of distributive share. As we have seen in the partnership also, when a appreciated property is being distributed, then that appreciation, that is a gain, will be added to the income of the S corporation and ultimately it will be passed on to the shareholders. Basis of shareholder is adjusted in the following order: increase all the income items, decrease a distribution from the S corporation, decrease non-deductible items, and then decrease the deductible expenses and losses. So these order for adjustment of basis. We have seen the basis formula, but this is going to be the order for adjustment. Shareholder to recognize a capital gain only when distribution exceeds the basis as under: cash plus FMV of the property received less debt on the property assumed by the shareholder less basis of the stock. In short, it's a capital gain calculation. So whatever you are receiving from the corporation, that is a cash or fair market value of the property, then you need to reduce debt assumed, if any, and then you need to reduce the basis of the stock to calculate a gain. Now what will be the distribution order? Let's see. First distribution is from AAA, which is called as accumulated adjustment account, and accumulated adjustment account is, let's see, the definition is given here. Accumulated adjustment account is accumulated undistributed earning of a corporation which was previously a C corporation and has undistributed earning at the time of electing S corporation status. So what they want to say, when you was a C corporation and then you moved to S corporation, again it was previously a C corporation and now it has moved to the S corporation, then the earning and profit outstanding at the time of S election is called as a AAA account. Whatever earning is there, accumulated earning outstanding at the time of S election, it is called as a AAA account. So you need to remember this meaning. Okay, then the distribution is earning and profit from the earning and profit of a corporation, and then balance distribution is treated as a return of capital. Okay. However, corporation has an option to have a bypass election to treat the first distribution from ENP and then from AA. Okay, what they want to say? Whatever distribution is being made by S corporation to a shareholder, that that distribution will be first assumed from AAA along with OAA, that is other adjustment account. You can see the meaning over here. OAA is given other adjustment account, that is exempt income, nothing else, but it is a part of AAA. Second distribution will be assumed from earning and profit of a S corporation, and third distribution will be assumed to be return of capital. This is a sequence to be followed. Okay, whatever distribution is from AAA or OA, it is considered as a return of capital only. Whatever distribution is from earning and profit, it is taxable as a dividend income to the shareholder, and this is obviously return of capital. So treatment is given like this. Distribution from AAA or OAA is considered as a return of capital. Distribution from ENP is considered as a dividend income, and distribution from remaining distribution is considered as a return of capital. That's the same treatment. So shareholder will have to treat it like this. If he is getting a distribution from AAA, that is a return of capital, he will reduce the basis. If distribution is from earning and profit, he will treat it as a dividend income, and remaining distribution will be again treated as a return of capital. Okay, but corporation has a choice to change this order. They can treat first from earning and profit, then from AAA, and then return of capital. That is also given, but there is a bypass election. If they are making, then only this change will happen. Otherwise, default rule is this one: first AAA, then ENP, then ROC. Okay, fine. Let us say there is a S corporation. There is a shareholder X whose basis is, let us say, $10 per share. S corporation has a AAA balance of $4. It is having earning and profit of $3. And let us say S corporation made a distribution of $6 to the shareholder. Now, how to treat? Okay, this distribution of 6 as per a general rule will be first considered from AAA. It means $4 will be considered as a AAA distribution, and remaining will be considered as a ENP. So remaining 2 is a ENP. That will be considered as a dividend income. And this 4 will reduce the basis. So now your basis will be 6. Fine. This is option given to the shareholder. First, general rule is given first from AAA and then from ENP. If the shareholder wishes, then reverse can be done. What reverse can be done? First, it can be assumed from ENP. So out of 6, first will be 3, that is a ENP, that is a dividend part, and remaining 3 will be from AAA. That is a reduction of basis of the stock. So that option has been given. So you need to see in the question whether a bypass election has been chosen or not. If it is not, then general rule is there always. First AAA, then ENP, then return of capital. So that way you need to go. Okay. AAA is not used by the corporation who is always a S corporation from the beginning. Look at this. Obviously, the AAA rule is applicable to those corporations who were previously a C corporation and now they changed to the S corporation status. If they are S corporation from the beginning itself, AAA rule is not applicable. The corporation was previously a C corporation but had no earning and profit at the time of conversion to S status. What they want to say? It was a previously C corporation, moved to the S corporation but had no earning and profit at the time of conversion. Then no AAA account will be there. AAA can be negative only by losses but not by distribution of the property. It means what they want to say, you can distribute only up to the AAA balance. You cannot distribute beyond AAA balance. If there is losses, then it can move to the negative balance of AAA. Distribution of cash or property up to AAA and OA not taxable but reduces the basis of the stock, as we seen right now. Up to ENP is taxable as a dividend income, and balance distribution reduces the basis of the stock. So it means first and third have a same treatment, reduction of basis of the stock, and second is having a treatment of dividend. So that you need to consider for the purpose of taxability. Distribution of cash and not a property up to 1 year of termination of S corporation given a tax-free treatment, that is reduces the base of the stock up to AAA or OA. So if S corporation has been terminated, S corporation has been liquidated, let us say for example, or terminated, then in that case up to 1 year, if the amount is distributed from AAA or OA, then it can be treated as a return of capital, but it should be distribution of cash and not a property. So up to 1 year the benefit has been given even if the S status has been terminated. So this point you need to consider. Now, built-in gain. This rule we have already seen in the time of partnership. So there is a built-in gain rule is there. It means a gain on the sale of a built-in gain property. Now what is a built-in gain property? It means holding appreciated property at the time of S status election. Okay. Now what they want to say, let us say a corporation was previously a C status and now they moved to a S status. At the time there was a property whose adjusted basis was, let us say, 5,000 and FMV was 8,000 and there is a gain of 3,000. This is called as a built-in gain and this property is considered as a built-in gain property. Okay, so holding appreciated property at the time of S election. However, if S status from the beginning, then big rule do not apply. Obviously, if you are converted from C to S status, then only there will be appreciated property and then it is considered as a big property and the big rule will be applicable, otherwise not. If big property is sold within 5 years from the S election, big is taxable at a 21%. Built-in gain will be taxable at a 21%. If the big property has been sold within 5 years, then gain will be divided in two parts. Gain up to built-in gain will be taxed at a 21% and remaining gain will be taxed at a normal rates. If also holding a built-in loss property, the loss on sale set off the built-in gain. Okay, if there is a built-in gain as well as built-in loss, both is there, then it will be netted off each other and the net built-in gain will be taxed at a 21%. Big is limited to taxable income, so it cannot be more than that. Big is deductible in ITR. Whatever tax you are paying, that will be deductible in your income tax return against the ordinary income or as a capital loss if big is a capital gain. So whatever it may be, if it is an ordinary gain, then it is deductible against ordinary income, and if it is a capital gain, then it will be deductible against capital loss. Okay. Now, okay, if I just give you an example, small example to understand this, let's see with a example. For example, C corporation moved to S status. At the time there was a property A whose adjusted basis was 5,000 and FMV was 8,000. There was a property B whose AB was 5,000 and FMV was 4,000. Now this S corporation sold this asset within 6 months. Let us say property A has been sold for 10,000 and property B has been sold for 2,500. Now what will be the treatment? Okay, on property A, total gain is 10,000 selling price minus 5,000 AB is equal to 5,000. And there is a built-in gain. There was a built-in gain of 8 minus 5, 3,000. And balance gain will be of 2,000. Okay. Second, B property. B property, there is a loss. Loss AB 5,000 less selling price 2,500. So 2,500 is a loss. Out of that, built-in loss. Built-in loss was 1,000 and balance loss is 1,500. Now actually this built-in gain as well as built-in loss both are there, so it will be netted off. So net built-in gain will be 3,000 minus 1,000 is equal to 2,000. So this net built-in gain of 2,000 will be taxed at a flat 21% rate, and remaining gain and loss will be set off and taxed in the normal way as it is being done. So this rule you need to remember about built-in gain and built-in loss. There is a separate taxability at 21%, and that tax will be deductible against ordinary income or capital gain as we have seen. Now passive investment income tax, passive income investment tax. Okay, whatever passive income you are earning, on that there is going to be a tax. Passive income includes interest, dividend, royalty, rent income, etc. except dividend from subsidiaries. Excessive passive income, there is a passive income more than 25% of gross receipt. If your passive income is more than 25% of gross receipt, it is called as a excessive passive income. It will be taxed at a high corporate tax rate. Highest corporate tax rate will be applicable to passive income if it is more than 25% of gross receipt. These rules apply only if it was previously a C corporation and earning and profit exist. So this passive investment income rule is applicable only if it was previously a C corporation. Now it has been moved to S status and it had earning and profit when it was converted. However, IRS may waive the tax if the corporation distribute ENP within a reasonable time from the previous year. Okay, if the earning and profit at the time of conversion is there, but the corporation is agreeing that the earning and profit will be distributed within reasonable time and IRS gives a permission, then this tax can be eliminated with the permission of IRS. Now, LIFO recapture. If C corporation is converted to S corporation, it has to convert from LIFO to FIFO for inventory valuation. What they want to say, C corporation is allowed to follow LIFO method for the inventory valuation, but S corporation has to compulsorily follow FIFO method. They cannot use a LIFO method. So they have to switch from LIFO to FIFO method. Now, due to switching of the method from LIFO to FIFO method, there will be obviously adjustment to the income. Now, how to give effect to those adjustments? Any recapture of income due to such a change in the method is to be added to the last return of C corporation, and the tax on it is payable in a 4 equal installment on the due date of ITR of each year. Whatever adjustment will be there, it is to be included in the last return of C corporation. Look at this, C corporation. And the tax on it will be paid by 4 installments by due date of each year. So till next 4 years the tax will be divided and it will be paid on the each due date by the corporation. Now it is converted to S corporation, but it will be a liability of C corporation. So just consider it very carefully. So these are LIFO recapture rule. Whatever adjustment is there to be included in the return of C corporation, last return, and it is the tax is payable within 4 years in installments. Okay, so this being a theory for chapter number 20, S corporation distribution. Now friends, let us see the MCQs of chapter number 20, distribution and special taxes. Okay, first question. Hulk was a 100% shareholder of a Banner corporation having an initial basis of 30,000. During the year, corporation reported operating income of 5,000 and LTCL of 8,000. Corporation distributed 42,000 to the shareholder. How much of the gain is to be reported by Hulk in his return? Okay. Look at this, they are asking a gain to be recognized by Hulk in his return. Now, if we just see the order for basis adjustment, just see this, how the basis is to be adjusted. First, increase all the incomes, decrease a distribution from the S corporation, then losses and expense to be deducted. So, let's be very clear on this. By this rule, initial basis has been 30,000 plus income has been 5,000 less distribution 42,000. If we just make up to this 30,000 plus 5,000 is equal to 35,000 less 42,000. So there is a gain of 7,000 here because he is receiving distribution more than his basis. So 7,000 is a gain to be recognized. Now you will say, what about this LTCL? This LTCL will be carried forward. Whenever there is a basis, it will be reduced. Whenever there will be a basis, this loss will be set off. So right now, he will recognize a gain of 7,000 and the LTCL of 8,000 will be carried forward for a set off in the future year when the basis is created. So very important here is an order of adjustment. So that's to be taken care in this question. Next, CA Corporation was a C corporation decided to be converted to S status from 1st March 2019 when it had a property with a basis of 50,000 and FMV 80,000. It sold the property on 30 September 2019 for 1,10,000. How much will be a corporate tax liability on built-in gain? They are asking about built-in gain. See, there is a built-in gain 50,000 and 80,000, so there is a 30,000 of the built-in gain. and this property has been sold for 1,10,000. So total gain will be 110 minus 50 is equal to 60,000. Out of 60, 30 is going to be built-in gain and remaining 30 is going to be other gain, capital gain. Okay, and this built-in gain is going to be taxed at 21%, flat 21%. So 30,000 into 21% will be 6,300. So this is going to be tax liability, 6,300 tax on built-in gain. Next, a sole proprietor elected to be S status and contributed a property with an adjusted base of 5,000 and FMV 7,000. Corporation sold the asset within a 3 months for 10,000. How much of built-in gain is to be recognized? Friends, they are asking about a built-in gain. There is a built-in gain also. Actually, AB is 5,000 and FMV 7,000. So 2,000 of built-in gain was there, but it will not be recognized. Why? Because it has been converted from sole proprietor to S corporation. The condition is what? It must have been converted from C corporation to S corporation. It is a sole proprietorship to S corporation status. So the condition is not fulfilled. That's why built-in gain will not be recognized. Answer is 0. Built-in gain rule is applicable only when it has been converted from C corporation to S corporation status. An S corporation is a balance in AAA of 10,000. It earned a profit of 12,000 during the year. It distributed 15,000 to the shareholder. How much of income is recognized by the shareholder in the this distribution? Okay. Now you see distribution total has been 15,000. And if no other election is made, then first distribution is to be assumed from AAA, and AAA balance is 10,000, which is called return of capital, which will reduce the basis. And second distribution is to be assumed from earning and profit. Earning and profit is 12,000, but now distribution will remain only 5,000. So this 5,000 of distribution will be from earning and profit, which is to be recognized as a income. See, first 10,000 will be return of capital. It will reduce the basis of the shareholder, and remaining 5,000 is from earning and profit, which will be recognized as a income. The question has been asked, how much income is to be recognized? Answer is 5,000. That's D option is a correct answer. Recapture of income due to change in method if inventory valuation from LIFO to FIFO as a result of conversion from C corporation to S status is taxable to C corporation. The tax is payable. Okay. When there is a conversion from C corporation to S corporation and C corporation was following a LIFO method, then it has to be converted from LIFO to FIFO method. As a S corporation cannot follow LIFO, they have to convert it. So now the method will be changed from LIFO to FIFO, and by this, whatever adjustment happens, that adjustment is going to be considered for a tax purpose by C corporation in his last return. And the tax will be payable in 4 installments. The answer is C option, 4 annual installments. A corporation was a previously C corporation but then converted to S corporation. At a time, it had a property A and B with a AB of 5,000 and 8,000, while FMV 10,000 and 6,000. After 6 months, both these properties were sold for 12,000 and 3,000 respectively. How much of built-in gain is to be recorded? Okay, fine. 2 properties are there, property A and property B. Adjusted basis and FMV. Okay, adjusted basis was 5,000 and 8,000. And FMV was 10,000 and 6,000. So friends, here if you check the difference, it is 5,000 of built-in gain, and here it is 2,000 of built-in loss. And now this property has been actually sold for, property A has been sold for 12,000 and B for 3,000. So 12,000 and 3,000. Okay. Now total gain on sale, or total gain or loss on sale. See, 12,000 is the selling price and 5,000 was AB. So 12 minus 5 is equal to 7,000. And here it has been sold for 3,000. So 8 minus 3 is equal to 5,000. Out of this, built-in gain and other gain. See, built-in gain here was 5,000. So 5,000 is a built-in gain, other gain is 2,000. And out of this 5,000, built-in loss and other loss. Built-in loss was at 2000. So other loss will be 3000. Fine. Now built-in gain has to be set off against the built-in loss. So net built-in gain is going to be 3000. So the question they were asking that how much of built-in gain is to be recognized, answer is 3000, option B. So you need to set off a built-in gain of one property against a built-in losses of other property, so you get the net result for recognition in your return. Passive investment income tax is levied to a S corporation if passive income is more than 25% of gross receipt. Yes, it is true. It was previously a C corporation and then converted to S corporation, and earning and profit exists. Yes, it is also true. So both of the above are correct sentence. C is a correct answer. So friends, this being MCQs for chapter number 20, and it was a last session for S corporation. Now friends, let us see the discussion on chapter number 21, that is income taxation of fiduciaries. This is chapter number 21 in the entity taxation series, and this we are talking about fiduciaries. Till now we have made a discussion on C corporation, S corporation, partnership. This discussion has already been done. Now we are talking about fiduciary. Fiduciary means trust or estate. We can say fiduciary is equal to trust or estate. On that we are going to check the taxability. Fiduciary includes a trust and estate. They are taxable on the accrued income retained by them. Look at this, accrued income retained by them. So you have to keep in mind, if the fiduciaries keep the income in a retained earning form, they are going to be taxed on it. If they distribute the income, then there is no taxability. So retained income will generate a tax for fiduciaries. Let us first talk about a trust. Trust, it is a legal entity created by a transfer of property by a grantor, which is held and administered for a beneficiary. So a person, Mr. X, is, let us say, transferring a property to a trust, and the property will be held by the trust for the benefit of beneficiary. Let us say beneficiary is a Y. So X is called a grantor, here is a trust, and Y is called a beneficiary. So grantor has transferred a property to a trust for the benefit of the beneficiary, and this way it is going to be managed. Okay, so whatever benefit from the property trust will pass on to the beneficiary, and that will be the situation over there. Now there are different type of trust being there. First is a simple trust. It means a trust which distributes all income to the beneficiary but do not distribute corpus and makes no charitable contribution. Friends, three conditions to be fulfilled to be a simple trust. First condition, distribute all income, no retain earning. Second, do not distribute a corpus. Corpus will not be distributed, only income will be distributed. So corpus is not to be distributed, and it will make no charitable contribution. Three conditions to be fulfilled. All income to be distributed, corpus not to be distributed. Corpus means a fund what they have accumulated, it is not to be distributed. And third, no charitable contribution. If all these three conditions are fulfilled, then it is called as a simple trust. Second is a complex trust. What is a complex trust? The trust which is not a simple trust is called as a complex trust. Very simple definition. The trust which is not a simple trust is called as a complex trust. Fine. Okay. So what they want to say, if you do not fulfill any of these conditions, then you will not be a simple trust. You will be a complex trust. If you follow all the three conditions, you are a simple trust. If any of the condition has been breached, then it will be automatically a complex trust. Grantor trust. It means a trust where the grantor has a control over the property, or where the property will revert back to the grantor. Grantor has just given a property to the trust for the benefit of a beneficiary, and ultimately the property will revert back to the grantor when the terms terminate. So it is just, we can say, the grantor has kept all the control over the property, and he will decide where the property will go on the termination of the trust. That is called as a grantor trust. Meaning of certain terms. Terminable interest. What is a terminable interest? Interest in the property which ends on some contingency. Means when some contingency situation happens, the interest or the right on the property will be terminated. Contingency interest. Interest created on the happening of a contingency. On certain contingency, the interest will be given to some party. It is called as a contingency interest. And remainder man, the person who received the property on termination of the interest. Okay, fine. Let's say X has given a property to a trust, saying that the benefit should pass on to the Y. Sorry. X has given a property to a trust, saying that the benefit should pass on to the Y. Okay. And till the lifetime of X, the benefit should pass on to the Y. Once X gets dead, the property should pass on to the Z. For example, there is a terms in the trust that till the X is alive, the benefit should pass on to the Y. But when X get deceased, X get dead, the property should pass on to Z. So contingent event is a death of X. Once the X got dead, the Y's interest will be terminated and Z's interest will be created. So that we can say as a terminable interest and contingent interest. Interest of Y is going to be terminable interest and interest of Z is going to be a contingency interest. And Z will be considered as a remainder man who is getting a benefit on a contingency. Okay, now income tax formula for the fiduciary. How income tax will be calculated for a trust or estate? Gross income less interest, taxes, business expense, depreciation, charitable contribution, distribution deduction, personal exemption. These much things will be reduced. So you will get a taxable income, then tax rate to be multiplied, then you will get a gross tax, then credit will be reduced, and finally tax payable. Very simple formula. You need to just remember what expenses can be deducted. So you can just see over here, expense deduction is interest, taxes, business expense, depreciation, charitable contribution, distribution reduction, and personal exemption. These being deductible expenses. Income concept. Income is taxed once, either to a fiduciary or to a beneficiary. There is a single taxability only. Either a fiduciary will be taxed or a beneficiary will be taxed. Simple. Income computation. Same as an individual. There is no separate rules given. Whatever rules we have seen for the individual, the same rule is applicable for the fiduciaries. Personal exemption. For a estate it is 600, for a simple trust 300, and for a complex trust it is 100. It's a fixed amount given. Status of a trust may change year on year. That is, it may be a simple or a complex trust. You have to check every year what is the status of the trust, and accordingly you need to compute the income. The income which is distributed to a beneficiary is a deduction to the fiduciary and taxable to the beneficiary. So what they want to say, whatever income the fiduciary is earning, out of that income, if the distribution is made to the beneficiary, then it will be a deduction for the fiduciary and taxable to beneficiary. So you can simply remember the distributed income. The distributed income is taxable to beneficiary and deductible to fiduciary. No standard deduction or section 179 expense of is allowed to a fiduciary. Fiduciary will not get the benefit of a standard deduction or section 179 expense of. Expense is deductible. Two parts are there, subject to 2% AGI limit. It means these expenses will be deductible beyond 2% of AGI. Beyond 2% of AGI. It means if you incur an expense beyond 2% of AGI, then only it will be deductible. That is investment advisory fee. Only one expense is incurred over there. And not subject to any limit. It means these expenses are deductible irrespective of amount. Written preparation cost, appraisal fee of the property, probate cost, legal publication cost, and cost of certified copy of decease. So all these expenses will be deductible irrespective of any limit. Expenses are deductible for the estate, either in the income tax return or in the estate tax return. They have option. We have already seen at the time of federal estate tax. Federal estate tax we have already discussed in the individual taxation series. There we had discussed that certain expenses may be deducted either in the estate tax return or in the income tax return as per the choice of taxpayer. Net capital loss deductible up to 3,000 and balance carried forward. The same rule as we have seen for the individual. Descendants unused capital loss and net operating losses cannot be carried forward. Look at this. Descendants unused capital loss and NOL will not be carried forward to the legal heirs. So it will be just written off over there, nothing else. It cannot be carried forward to the individual legal heir. Admin expenses like a fiduciary fee, legal fees, court fee, etc. deductible in the income tax return if irrevocable waiver is elected in the estate tax return. Look at this. Admin expenses, as we told, will be deductible either in the ETR or in the ITR. If you have made an irrevocable waiver, then it will be deductible in the ITR and not in the ETR. Expense may be divided between ITR and the estate tax return. It is also the option given. Income distribution is a deduction for the fiduciary, as we discussed right now. Fiduciary is taxed on the undistributed income. If the income is not distributed, it is going to be taxable to the fiduciary. So you simply remember distributed income taxable to beneficiary, undistributed income taxable to fiduciary. The next concept, distributable net income, which is called as a DNI, distributable net income. DNI calculation, it will be accounting income less net capital gain, or we can say taxable income plus personal exemption plus tax exempt income plus net capital loss less net capital gain allocable to corpus. This formula you can use to calculate distributable net income. Two formulas may be there: accounting income less net capital gain, or taxable income plus personal exemption plus tax exempt income plus net capital loss less net capital gain allocable to corpus. So any of the formula you can use. Capital gain may be included in the DNI if distributed to beneficiaries. Capital gain part can be included in the DNI if it is distributed to beneficiary. Just look at this. If not distributed, then not included. If distributed, then included. Distribution is a deduction to the fiduciary and income to the beneficiary up to DNI. That's a good point. You need to calculate DNI, and up to DNI only it will be taxable to the beneficiary. Beneficiary is taxed on the undistributed income as per a year end of the fiduciary. So beneficiary will include the income in his return when fiduciary ends the year. Okay, procedural rules. Tax year. Trust has to follow calendar year only, and estate may follow any of their that we have already seen in the previous sessions. Return filing by 15th of the 4th month of the year end, that is next day if it is holiday, and extension of 5.5 months is allowed. So you have to file a return by 15th April. 15th April is a day when you have to file the return. 5.5 months extension is also being allowed for if you could not file the return within the date. Advance tax. Trust has to pay advance tax in each and every year. Estate has to pay only after 2 years. Estate has to pay advance tax only after 2 years. ITR must be filed if the gross income is more than 600, it has a taxable income, and fiduciary is non-resident alien. Beneficiary is a non-resident alien. So any of these three conditions are being fulfilled, income tax return has to be filed by fiduciary. AMT calculation, it will be same as an individual, but AMT exemption amount will change. That will be 25,000, and that is an inflationary figure. Year on year it changes. 3.8% Medicare contribution tax is being levied on the net investment income at a lower of undistributed net investment income or excess of AGI over AGI level where the highest tax rate slab begins. So 3.8% Medicare contribution tax will be levied on net investment income. Net investment income at a lower of undistributed net investment income or excess of AGI where the AGI level highest tax rate slab begins. So you need to consider the AGI level where the highest tax rate slab begins, and if your AGI is more than that, then the difference will be considered. So you need to take a lower of these two. Lower of these two means one is undistributed investment income and second is the AGI above that level, whichever is lower. On that the tax is going to be levied 3.8%. Income in respect of descendant, which is called as IRD. Income not included in the descendant's income tax return, included in the estate's tax return. It will not be included in the descendant's return, it will be included in the estate's tax return. Income and expenses up to the date of death is reported in the descendant's return. Obviously, up to the date of death, whatever has been earned by the descendant, that will be in the descendant's last return, and remaining income and expenses will be shown in the estate's tax return. Treatment of a distribution to a simple trust. Income of a trust up to DNI is passed on to the beneficiary even if not distributed actually. See, this is a simple trust rule. Up to DNI it is going to be taxable to beneficiary whether distributed or not. If there are multiple beneficiaries, then income is prorated to all as per their respective share. Treatment of a distribution to complex trust. Distribution is divided in two parts. First year distribution, that is a distribution required first to be paid out of income, and second year distribution, that is all other amount actually paid out of income to the corp or the corpus. DNA is first allocated to the first year distribution, and then DNA is allocated to second year distribution. If more than one beneficiary, then DNA is prorated. So there will be a two-tier distribution, first year and second year. First year distribution, then DNA is allocated to first year, and then remaining DNA can be allocated to second year distribution. Fine. First year means nothing but a distribution required as per the deed, as per agreement, to pay to a certain beneficiary. That is the first year, and remaining distribution will be considered as a second year distribution. So this being theory for chapter number 21, beneficiary or fiduciary taxation. Let us see MCQs for chapter number 21, fiduciary taxation. First, which of the following is not taken into account to calculate a DNI? Which will be not taken into account to calculate DNI? Friends, personal exemption. Personal exemption we are reducing from it. Personal exemption we are reducing from it, so it is not taken into account. Answer is A option. Tax exempt interest, taxable interest, admin expenses, everything will be taken into account, but personal exemption will be reduced. Next, there was a income of a simple trust from a capital gain 30,000, interest from a corporate bond 10,000, interest from municipal bond 5,000, and admin expenses 4,000. How much of will be DNI if capital gain is to be distributed as per a trust deed? Capital gain can be distributed, so it will be a part of DNI. Now you need to just add everything. Capital gain 30,000, interest from corporate bond 10,000 plus interest from municipal bond 5,000 to be added, and admin expense to be reduced 4,000. So net answer 41,000. 41,000 is going to be income DNI. 41,000. A capital gain has been included because it is to be distributed. That's why. A trust reported a DNI of 90,000. It had distributed 80,000 to X and 40,000 to Y as per agreement. How much of income is to be reported by X if the trust distributed the said amount? Okay. Now 80 and 40, so 1,20,000 total distribution has been made, and 90,000 is actually DNI. So 90,000 will be prorated between these two. So 90,000 into 80,000 divided by 120 is equal to 60,000. 60,000 of income will be recorded by X. It is a prorated, nothing else. Next, a trust had a DNI of 10,000 while it distributed 15,000 to a member. How much of income is taxable to trust and a member? See, a trust has distributed everything, so nothing is taxable to a trust, but a member will be taxable only up to DNI. So DNI is at 10,000. So answer will be 0 taxability to trust, and taxability to member will be 10,000. Option C, 0 and 10,000 is the correct answer. Next, a trust is said to be a simple trust if it distributes all of its income to a member. Yes. Do not distribute a corpus. That's also true. Make a no charitable contribution. That's also true. Answer is all of above. D is the correct option. Next, a trust where the donor has a power over the property or a property will revert back to the donor is called which type of trust? It is called as a grantor trust, where the grantor has a control over the property and he will decide where the property will go back. Which of the following is allowed to a fiduciary? Which will be allowed? Standard deduction? No, it is not allowed. Section 179 expense of? It is also not allowed. So none of above. Answer is D. None of above will be allowed to them. Income distribution up to DNI is income to the beneficiary. Yes. Deduction to the trust. It is also true. So answer is C. Both of above. Expense of the estate are deductible in estate tax return or income tax return at their option. So it will be either of the above. C is the correct option. A trust reported an interest income 10,000, municipal bond income 6,000 and capital gain 5,000. How much of income will be taxable to the member? Now see, if we talk about a normal rule, capital gain is not to be included in DNI calculation unless it is to be distributed. Now here nothing is specified, so we are assuming that capital gain will not be included in the DNI. So only the two income, interest income 10,000 and municipal bond 6,000. So 16,000 is going to be taxable income to the member as a part of DNI. Which year is to be followed by trust and the estate? Friends, trust can follow any year, and trust has to follow calendar year and estate can follow any year we have seen in the theory. So calendar year and any year. B is a correct option. In which of the following situation tax return is to be filed by the trust? When trust has to file the return? Gross income more than 600? Yes. Taxable income, yes. And beneficiary is a non-resident alien, yes. All are the correct option. So answer is either of the above. D is a correct option. Income in respect of the descendant means income which is accrued to the descendant but not received. Yes, that's a correct option. Which has been accrued but not received. That we have also discussed in the individual taxation chapters, that what is IRD, what is income in respect of descendant. The same concept is here. A trust had an agreement to pay 1000 to X and any other amount payable to Y and Z as per its discretion. During the current year, a trust reported DNI of 2000 and trustee distributed 1000 to X and 800 to each of Y and Z. How much of income will be taxable to Z? Now, what you need to consider, these are complex trusts actually, and distribution will be first year and second year. Now, first year distribution is to X, which is 1000, and this will be considered out of DNI. So first DNI will be allocated to this distribution. Now total DNI is 2000, out of that 1000 DNI has been passed on to X. Now remaining DNI 1000 will be allocated between Y and Z proportionately. Now the distribution has been 800 and 800. So you need to make this in ratio, it means equal. So 1000 will be distributed equally to both of them. So it is going to be 500, 500. Now what the question they are asking, that how much income is taxable to Z? It will be 500 of the income, because out of 800, 500 distribution is going to be out of DNI. So 500 will be taxable. Option B is a correct answer. So these being MCQs for chapter number 21, fiduciary taxation. Now friends, let us see the next chapter number 22, business tax credits. Okay. The tax credits which are available to corporations, corporate entities, that we are going to discuss here. We had seen the tax credits at a time of individual taxation also. That was called a personal tax credit, and this is called a business tax credit. So certain business tax credits being allowed to corporate entities, that we'll be discussing here one by one. First credit is a foreign tax credit. Now what is a foreign tax credit? We have some initial discussion at the time of a foreign taxability, the taxation of foreign income. We had discussed it at that time. Foreign tax credit is nothing but when a person is paying a tax on a particular income in home country as well as in the foreign country. So whatever tax he has paid in the foreign country, for that he is going to get a credit in his home country. So that is called the foreign tax credit. And how it is calculated, let's see. If income is taxable in US as well as in the foreign, the credit is allowed for the tax paid in the foreign to mitigate the double taxation. Simple logic is there. To just avoid a double taxation, the foreign tax credit is being allowed. FTC is allowed at a lower of tax as per US rates into foreign income divided by total income or actual foreign tax paid. Now see, you need to just consider very carefully. Let's say there is a corporation, C corporation, who has US income worth 1 lakh, foreign income worth 60,000, tax in US has been 20,000 and tax in foreign, let us say, for example, it has been paid at 8,000. Now, how to get a FTC? How to calculate a FTC? For FTC calculation, you need to check this formula. Tax as per US rates into foreign income divided by total income. Okay, so US tax has been 20,000 into, you need to take foreign income divided by total income. Foreign income has been 60,000. And total income will be 1,60,000 if you just make a total of it. Then let's see how it is coming. 20,000 into 60,000 divided by 1,60,000. So it will be 7,500. So 7,500 or actual foreign tax paid, that is 8,000. Whichever is lower, that credit will be allowed. So 7,500. 7,500 of FTC will be allowed in the current year. So that's a formula you need to follow. Tax as per US into foreign income divided by total income. That formula is to be applied. Okay, taxpayer has an option to claim instead of FTC, he can claim itemized deduction for the foreign taxes paid. As we have seen in the itemized deduction, there is a tax column is there. So in that you can get FTC, or exclude foreign income up to 1,05,900 if we stay in the foreign countries at least 330 days. This discussion we have also made at the time of taxability of foreign income. So it is having an option. Either he can claim FTC, or he can claim itemized deduction, or he can claim exclusion of the foreign income up to 1,05,900, provided the condition is fulfilled, that is stay in the country is more than 330 days. Now general business credit. General business credit, this credit is limited to regular tax liability less personal tax credit less 25% of regular tax minus 25,000. There is a formula you need to apply. See, general business credit, there is a combination of different credits into a general business credit. General business credit is a combination of different credit which is subject to limit, and this will be limited up to regular tax liability less personal tax credit. So first of all, remove personal tax credit, then reduce 25% of regular tax credit minus 25,000. Whatever amount you are getting here, that will be limit on general business credits. Fine. The above limit is applied to all the credits combined in total, which is subject to limit. That is, as I told you, there are so many credits included in the general business credit, and the limit will apply to all the credits in total. This credit cannot reduce the tax liability below tentative tax liability. Look at this. Cannot reduce below tentative tax liability. Means general business credit will be allowed only up to tentative tax liability. It cannot go beyond tentative tax liability. For that we are calculating for the AMT purpose. Excess credit to be carried back 1 year and carried forward 20 years. So if general business credit is in excessive, then it will be carried back 1 year and carried forward for 20 years. Okay, now let us discuss the credits one by one. Rehabilitation credit. It is a credit allowed for rehabilitation expenditure incurred on some properties. Up to 2017, the credit was allowed at a 10% of rehabilitation expense incurred on the property placed in service before 1936. Means up to 2017, the credit allowed was 10% of the expense incurred, and the credit was allowed immediately. The credit is recaptured if the property is sold within 5 years. That provision was there up to 2017. Now from 2018, the provision has been changed. The credit is allowed at a 20% on the rehabilitation expense incurred on a historic structure property, but the credit will be allowed in a 5 annual installments at a 20% per annum. 5 equal annual installment credit will be allowed, so 20% credit each year. So you need to just see the year very carefully. Up to 2017, if the expenditure is incurred, credit will be 10% and it will be allowed immediately. But if you sell the property within 5 years, it will be recaptured. And from 2018, the credit is 20%, but it is allowed in 5 annual installments. Credit reduces the basis of the property. So whenever you get a credit, the basis of the property will be reduced. Credit is allowed only if the depreciation is claimed on SLM or ADS basis. Look at this. If you charge depreciation as per SLM or any of the alternative depreciation system, it means if you do not follow markers, you will get this credit. If you are following markers, you will not be allowed this credit. That's very clear on this point. Next, small employer health insurance credit. Credit is allowed to a small eligible employer at a 50% of the health insurance premium paid by employer on behalf of. So the credit is allowed to a small eligible employer at a 50% of the health insurance premium paid by the employer on behalf of employee. If the small tax exempt employer, if he is a small tax exempt employer, credit is at 25%. Okay. Normally 50% credit is allowed, whatever health insurance premium has been paid by employer on behalf of employee, the 50% credit will be allowed. And if he is a small tax exempt employer, then credit will be 25%. Eligible employer is the one who contributes at least 50% of the health insurance premium of the employee. Okay. To be eligible, you have to pay 50% of health insurance premium expense of the employee. Full credit is allowed if number of employees are less than or equal to 10 except the owner and the family, and average annual wage is less than or equal to 26,200. So if number of employees are less than or equal to 10 and average wages is less than or equal to 26,200, you will get a full credit. And if the number of employees exceed this limit or wages exceed this limit, then phase out will apply. How? Let's see. Credit is phased out when the number of employees exceed beyond 10 or wage increases beyond 26,200, and the credit is fully phased out when number of employees reaches 25 or wage reaches 52,400. So it means credit will be allowed in between this limit. If it exceeds beyond the limit, if it exceeds the beyond limit, then your credit is going to be fully phased out. Okay, the excess credit to be carried back or carried forward, the option is given, carry back, carry forward option is allowed. Next, work opportunity tax credit, which is called as a WOTC. It is an elective credit. First of all, if the taxpayer elects, then the credit will be allowed. Credit is applied on the wages paid during first year of employment. Look at this, wages paid during first year of employment, the credit is going to be allowed. Credit is allowed at a lower of 40% of wages paid or 2,400. 40% of wages paid or 2,400. That is going to be a credit. Credit is allowed for the wages paid to the veterans, that is a long experienced person, and long-term unemployed persons. It should be a veterans. It means it should be a experienced person. The wages paid to this person is going to be a credit allowed. Wage deduction is reduced by the credit allowed. Look at this. If you get a credit, then the wage deduction will be reduced. So that you are getting some of the credit. Let's say you paid a wages of 1,000 and you got a credit of 400. Then your wage deduction will be reduced by 400. You will get a net 600 of wage deduction and 400 as a tax credit. So that option is given to you. Okay, but again look at this. These allowed only for the first year. Whatever wages you are paying in the first year of employment, only for that the credit is allowed, not for all the years. Now the research credit. Credit is allowed on the research expenditure incurred in the US only. It should be in the US only, but it should not relate to the commercial production, surveys, social science, etc. It should not relate to commercial production, surveys and social science. Credit is allowed at any of the following option to the taxpayer. Incremental research credit equal to 20% of the incremental research expenditure incurred, or specified credit equal to 14% of the research expense less 50% of the average research expense incurred in past 3 years. Two options has been given. Incremental research credit equal to 20% of incremental research expenditure incurred, or simplified credit equal to 14% of total research expense less 50% of average research expense incurred in past 3 years. So either of the option can be chosen by the taxpayer for the purpose of taxability. Credit deduction. No deduction is allowed for a research expense, only the credit is allowed. Credit is also allowed for AMT purpose if a gross receipt, average gross receipt is less than or equal to 50 million in the past 3 years. So there is a condition for claiming this credit in AMT. You need to consider this. Next is a low income housing credit. Credit is allowed to the owner of a housing project. Owner of housing. If someone is having a housing project going on, then the owner will get a credit on sale of houses to a low income taxpayer. Credit is equal to certain percentage depending on whether the existing house project is purchased or new constructed and financed by tax exempt bonds or otherwise. So that depends upon the different conditions. Of a depreciable basis of the property owned by eligible low income individual. Look at this. In a housing project, how many houses have been sold to a low income individuals? Whatever house is being sold to the low income individuals, on that you will get a credit. That's a first condition to be applied. Credit is allocated over 10 years, beginning with the year in which the property is placed in service by eligible individual. Look at the word. Credit will be allowed in next 10 years. It will be divided in 10 years. Okay, in the starting with the year in which the property has been placed in service by eligible individual. And who is eligible individual? It means a low income taxpayer, low income individual. Okay, disabled excess credit. Credit is allowed to a small business for expense incurred to make a business accessible to disabled person. If a small businessman is incurring the expense on a person who is a disabled to make him eligible to business. Let's say he is a disabled and he cannot do any activity to do a business. So the person is incurring certain expenditure to make him eligible to do a business. That is called a disabled excess business. Okay. Credit is allowed at a 50% of the expense incurred above $250 but maximum up to $10,250. So expense allowed is above 250 but up to 10,250. So it means 10,000 of the expense is allowed and you will get a credit up to 50% of the expense incurred. The small business whose gross receipt is up to 1 million or it has a full-time employees less than or equal to 30 are eligible for this credit. Look at this. Who will be eligible for this credit? Either of the one condition. His gross receipt should be less than 1 million or full-time employees should be less than or equal to 30. Then this credit will be allowed, otherwise not allowed. So these are very simple. If you incur an expense on a disabled person to make him eligible to do business, then the credit is allowed. Next, empowerment zone employment credit. Empowerment zone employment credit. Credit is at 20% of the first 15,000 of the wages paid to the employees who are resident of the empower zone and work in such a zone for a trade or business of the employer. Okay, look at this. Credit is at 20% of first 15,000 of wages paid to employee. Certain zones have been declared to be an empowerment zone and the employees working in that empowerment zone, the person is paying a salary expense to them and up to 15,000 of the salary. First 15,000 of salary expense will be eligible for 20% credit. So that is called empowerment zone credit, specifically allowed to just motivate the empowerment zones for the purpose of employment. Employer social security credit. Credit is allowed for a FICA taxes paid by food and beverage establishment on the tips, not on the wages. Look at this. If they are paying taxes on the tips income, then on that they'll be allowed a credit. That is called as a social security credit. See, you know, two types of credit being allowed on the social security tax and Medicare tax. The social security tax being paid by them, which will be allowed as a credit to them. So these are point they want to say. But these only on the tips and not on the wages. It is specifically for food and beverages establishment like restaurants. Employer provided child care credit. Credit is allowed at a 25% of qualified child care expenditure and 10% of a qualified child care resources and federal expenditure, referral expenditure, maximum up to 1,50,000. Qualified expense is equal to acquiring a property for a child care of the employees while they are into employment. So many of the employees are working and their child has to be taken care. So employer is incurring an expense to just take care of the child of the employee at the premises or at any other place and incurring expense on the property, certain specific properties being needed. So that expenditure will be eligible for the credit and credit will be allowed at a 25%. Adjusted base of the property is reduced by such a credit. Whenever you get a credit of this, the adjusted base of the property will be reduced for that amount. Okay. Employer paid medical and family leave credit. Medical and family leave credit, you know, in the organizations, the employees are getting certain leaves, we can say paid leaves rather. So there is a family and medical leave. Certain employees are there who have not taken this family or medical leave and they are getting a payment for it. That is called encashment of the leave. For that, the credit is being allowed here. Let's see. Credit allowed at a 12.5% of the wages paid for the family leaves and the medical leaves. For this purpose of credit, the employee to receive more than equal to 50% of the normal wages and employee to get at least 2 weeks as a medical and family leave. If these two conditions are fulfilled, then only this credit is allowed. First, the employee must receive more than 50% of normal wages, and second, at least 2 weeks of the family and medical leave payment should be given to the employee. Then only this credit will be allowed. Credit percentage increases by 0.25% for each 1% increase in the wages above 50% and maximum credit percentage will be 25%. So it starts with a 12.5% but it can move to 25% by each 1% increase in the wage payment. Now let's say the employee has been paid a wage of 54%. So more than 50%, 54% wage has been paid. So by each 1% the credit increases by 0.25. Now you are paying 4% more, above 50%, 4% is more. So accordingly 1% credit should be increased. So 12.5% credit will be increased to 13.5%. So that way you need to calculate. So friends, this being a different credits as called as a general business credit. This being a theory. Let us see the MCQs, friends. Business tax credit, chapter 22. First, For the foreign taxes paid, the taxpayer has an option to, okay, whenever a foreign tax has been paid, the taxpayer has an option to claim a foreign tax credit. Yes, he can claim. Itemized deduction. Yes, he can do. So either of the above. C is the correct option. He is having both the options available. Taxpayer earned a US income 1,20,000, foreign income 1,80,000. He paid a foreign tax 36,000 and US tax 45,000. How much of foreign tax credit will be allowed to a taxpayer? Okay, for the foreign tax credit, you need to make a formula. First formula, US tax into foreign income divided by total income. That is the first formula. Or actual foreign tax paid, whichever is lower. Okay, now first of all, let's find here US tax. How much is the US tax? 45,000. US income 120, foreign income 180. So first of all, putting here 45,000 into foreign income is 180 and total will be 3 lakhs. 1,80,000 and total 3 lakh. 180 plus 120. So let's make it 45,000 into 180 divided by 3 lakhs. So it is 27,000. And actual foreign tax paid has been 36,000. Whichever is lower answer will be 27,000. So you will get a credit of 27,000. C is the correct answer. Fine. So you need to just get a formula and the answer is there. Excess general business credit about tentative tax liability to be. If the credit is beyond tentative tax liability, then it will be carried back 1 year and carried forward 20 years. That is the correct option. B is the correct answer. Rehabilitation expense incurred on a historic property in 2019. Rehabilitation expense incurred in 2019. How much credit is available? 20% credit is available and divided into 5 annual installments. B is the correct option. 20% credit, 5 annual installments. Work opportunity tax credit is allowed at how much WOTC will be allowed? It will be 40% of the wages paid in the first year or 2,400, whichever is lower. So D is a correct option. Next, research expense incurred in 2017, 18 and 19 were 10,000, 15,000, 20,000 respectively. How much of research credit is available in 2019? Okay, for the research credit you do have a two option. First option, you just make a 20% of incremental research expense. Now, incremental research expense means the expense incurred in 2019, that is 20,000. So we can make a 20% of 20,000, it will be 4,000. That is one thing. Second option, 14% of total research expense less 50% of average research expense. Okay, so let's make it 14% of total research expense will be total of all these three. It is coming to 45,000, 10 plus 15 plus 20 less 50% of average. Average means 45,000 divided by 3. So again 14% of 45,000 minus. This average is going to be 15,000 and 50% of 15,000 will be 7,500. So just make it 45,000 minus 7,500 into 14%. It is 5250. So one option is 4,000, another option is 5250. Option is given to the taxpayer. So obviously he will take this option 5250, where he is getting more credit. The answer is A option, 5250. This credit will be allowed for research expense. Next, taxpayer incurred an expense of 6250 during 2019 to make a disabled person eligible to do a business. How much of tax credit will be allowed to him? Okay, disabled excess credit. Disabled excess credit, you remember, it is allowed for the expense above 250, and it should be less than 10,250. So expense incurred has been 6250, or 6250 less 250, so we are making it 6,000. Okay, into 50%. So 50% credit will be allowed, that is 3,000. 3,000 is the correct option. B is the correct answer. Maximum medical and family leave credit is allowed at family and medical leave credit. How much is the maximum percentage? It is at 25%. Remember, it starts with a 12.5%, and for each 1% wages beyond 50%, it will increase by 0.25%. So maximum it can reach to 25%. That's not more than that. The combination of several credits where there are uniform rules for a carryover is called, combination of different credits with the uniform rules is called as a general business credit. So D is a correct option. So these being MCQs for tax credit chapter. Now friends, let us see chapter number 23, business entity choice. This being the last chapter in the entity taxation series. Here we are going to discuss that what choice is available to an entity. Means an entity is having a different choice to be taxed. Either they can be taxed as a partnership or they can be taxed as a corporation. So what choice they can have and how the choice will be eligible to a different persons. Let's see. Legal forms of business, first of all. Sole proprietorship, no separate legal entity, that's an individual doing a business. General partnership, limited liability partnership, limited liability companies, corporation and a business trust. This bifurcation we can make for the purpose of business formats. Okay, classification for tax purpose, it will be corporation, either C corporation or S corporation, partnerships, trust and sole proprietorship. This is a classification as per tax. Types of partnership. If we talk about a partnership, then types of partnership. General partnership. Each partner is a general partner, not a limited partner. Liability of each partner is unlimited. If you are a general partner, your liability is unlimited. Personal responsibility is there. Partner is personally liable for the debts of a partnership even in the case of fraud. If you are making a fraud and the personal liability is being incurred, you are liable for it. Means the partner is responsible personally for each and every transaction of partnership. That is called general partner, and all the partner will be considered as a general partner in a general partnership. Limited partnership, at least one general partner and one limited partner will be there into a limited partnership. Liability of the limited partner is limited up to his capital contribution, while the liability of general partner is unlimited. Limited partner cannot actively participate in the management of the partnership. In the under sense, we can say it's a sleeping partner or a dormant partner. General partner is an active partner, limited partner is a sleeping partner. Limited liability partnership. Partner is not liable for the negligence fraud of the other partners. However, he is personally liable for his own fraud or negligence. If we talk about a LLP, limited liability partnership, a partner is responsible for his own fraud but not for the other partner's fraud. LLP is a famous generally for the service industries rather, as the concept is that the service industry like a chartered accountant, CPAs, doctors, lawyers, all are making the LLP partnerships. Limited liability company, LLC, we can say almost rules of a partnership are applied to the LLC. Combines the benefits of limited liability, taxability of the pass-through entity and flexibility of partnership taxation. So all these benefits are combined for limited liability company. Okay, now check the box regulation. What is a check? A different situation where what rules will be applicable and how you can be treated as a taxability purpose. First of all, per se corporation. What is a per se corporation? Entities incorporated as a per se corporation taxed as a corporation only. Either C corporation or S corporation. Per se means only and only. They are incorporated only as a corporation. So they cannot be taxed in the other format. They can be taxed as a corporation only. Whether C corporation or S corporation depends on their condition fulfillment. They do not have an election to be taxed as a partnership. If they are incorporated as a per se corporation, it means only corporation. Then no other option, only to be taxed as a corporation, partnership election is not available. They include, which corporations are included as a per se corporation? Entities incorporated under a state law, insurance companies, state chartered banks, publicly traded partnership, specified foreign entities, tax exempt organizations, and REIT, that is a right trust. So these are the entities which will be always taxed as a corporation and not as a partnership. This is called a per se corporations. Other corporations have an election to be taxed as a partnership or as corporation. Other than above, the corporation have an option to be taxed either as a partnership or as a corporation. If no election is made, the default status is a partnership when there are two or more owners, or a sole proprietor if there is a one owner. So other than above, the corporation is a choice either to be taxed as a partnership or a corporation. If no election is met, then partnership is a default status. If two or more persons are there and one person, then sole proprietorship. If you make a proper election, then you will be taxed as a corporation. An election to be taxed as a corporation has to be filed within the first 75 days of the year. This provision we have already seen. If you want to be taxed as a corporation, you need to make an election within first 75 days. Election can be changed after 5 years or with the permission of IRS. So whatever election you are making, that is applicable for the 5 years. So only after 5 years you can change your election, or if IRS gives a permission, then the change is allowed. Now we are looking at a comparison between different entities: C corporation, S corporation, partnerships, LLC and sole proprietorship. So let's see the difference between this. Limited liability. C corporation, yes, limited liability is there. S corporation, yes, limited liability. Partnership, general partners don't have a limited liability, but limited partner have a limited liability. LLC, yes, there is a limited liability, and sole proprietor, no, it is unlimited liability. Double taxation. C corporation, yes, it is going to be double taxation, tax to the C corporation as well as to the members. S corporation, no, it is going to be a flow-through entity. Only members will pay the tax. S corporation will not pay the tax. Partnership, no, it is not a double taxation entity. Partnership will not pay the tax. Partners will pay the tax. LLC, not a double taxation. Sole proprietor, not a double taxation, because only individual is going to pay the tax. Retain income at a low tax rate. Retaining income at a low tax rate. In a C corporation, yes, it is possible, because if you retain the income into the C corporation will be taxed at a lower rate than individual. So you can retain the income at a low tax rate rather than distributing to the shareholder. In S corporation, it is not possible because all the income is going to be taxed to the members. Partnership, it is not possible. LLC, not possible. Individual, it is never possible, not applicable at all. Tax deferred contribution. Can you make a contribution which is non-taxable? In C corporation, yes, but it is subject to control test. We have seen the control club rule. For the control club rule, this is applicable, that gain on the transfer of property is deferred. S corporation, yes, again subject to control club rule. Partnership, always yes. LLC, yes, and sole proprietorship not applicable at all. Double taxation on distribution of property, yes, on a C corporation it is. Corporation has to pay tax as well as shareholder has to pay tax. S corporation is also having the same problem. Partnership has no such problem. LLC no problem. Sole proprietorship no problem. Change in the owner's basis for entity level debt. Okay, when there is an increase in the entity level debt or decrease in the entity level debt, will partners basis change? Will members basis change? For company it is no. For a C corporation, S corporation, no. For a partnership, yes. For LLC, yes. And for sole proprietorship, not applicable. Flow through of entity. Okay, whether C corporation is a flow through entity? No. S corporation? Yes. Partnership? Yes. LLC? Yes. Sole proprietorship? Not applicable at all, because only individual is going to pay the tax. Profit sharing. In a C corporation, as per contribution ratio. S corporation, contribution ratio. Partnership, any ratio decided by partner. LLC, any ratio decided by partners. And sole proprietorship, not applicable, because only one person is there who is going to take all the profit. So friends, this being a comparison between different organizations, and accordingly you can choose which organization to be selected for tax purpose according to your requirement. Depending on the situation, you can have an election to be taxed as a C corporation, S corporation, partnership, LLC, or a sole proprietorship, depending on condition fulfillment as well as on the beneficial rule to the taxpayer. So this being theory for this unit. Now friends, let us see the MCQs of business entity choice, chapter number 23. First, a partnership where a liability of all the partners are unlimited is called general partnership, because in general partnership all the partners are general partner and liability is unlimited. Which of the following is true about a general partnership? It has a all general partner. That is a true sentence. A is a correct option. All general partners will be there whose liability will be unlimited. That is a general partnership. It cannot have a limited partner at all. The partner who do not actively participate in the management of the partnership and have a limited liability are called, this is a definition of limited partner, means who is not personally liable and who do not actively participate in the management is called a limited partner. In a limited partnership, there are all limited partners, there are all general partners, there must be One general partner and one limited partner. C is a correct option. In a limited partnership, one general partner is compulsory and one limited partner is compulsory. Remaining, it can be any combination. Entities incorporated as a per C corporation to be treated as a except. Okay, per C corporation will be treated as a except, means per C corporation cannot be treated as partnership. C option is the answer. They can be treated as a S corporation or a C corporation, but they cannot be treated as a partnership because this is per C corporation. When two or more persons are engaged into a business and no election is made, the default status for taxability is when there are two or more persons who are engaged into a business but no election is made for the taxability. They have not made an entity choice. Then what is the default entity choice? That is a partnership. A is the correct option. An election to be taxed as a corporation is to be made within, if you want to be taxed as a corporation, the election has to be filed within first 75 days of the year. B is the correct option. Which of the following is not a flow-through entity? Not a flow-through entity. Partnership, yes, it is a flow-through entity. S corporation, yes, it is a flow-through entity. C corporation, it is not a flow-through entity. So C option is a correct answer. Change in the debt level of entities changes the owner's basis. Which of the following is irrelevant in this context? It means in which of the following entity change in the debt level will not change the partner's basis? Answer is C corporation. For a C corporation, change in the debt level is not going to change the shareholders basis into C corporation. Remaining partnership, LLC all have that option that change in the debt will change the partners members basis into the partnership or corporation. So friends, it is a MCQs for chapter number 23 and it was a last chapter for entity taxation. See, we have completed an entity taxation discussion here friends. You need to see all the rules, all the chapters very clearly. You need to remember the rules for the purpose of examination. They are asking the MCQs and test-based simulations. So must go through the rules very clearly and very neatly so that you will be able to solve the MCQs very easily. Navkar Digital Institute is always there for the students. We are working hard to just serve you better. So see all the chapters and solve all the MCQs and you will be able to 100% clear the exam. All the best. Thank you.
If you like this video, share it with your friends. Subscribe to our YouTube channel to watch more such videos and learn from our expert faculty members. Press the bell icon to get regular notifications whenever we upload a new video. Download NDI mobile app to get complete CA course online. We value your support. Thank you for watching.